Hello, and welcome to another episode of This Week in Intelligent Investing. I'm really excited to be joined today by Yaron Naymark of One Main Capital. Yaron is a good friend and a fellow manager who I really admire for his exceptional deep work on the companies in his portfolio, generating great returns since inception. Yaron concentrates intensely both in the metaphysical and portfolio sense, and this is a theme we'll explore today. In today's episode, we will discuss Yaron's genesis as a fund manager, the current landscape, and a few interesting ideas. So, welcome to the podcast, Yaron.
Thanks for having me.
So, to start, maybe, talk about what gave you the big, bold idea to go off and start your own fund. What inspired you, and what were you looking to accomplish?
What inspired me? I think it sounds a little corny, but the Bezos regret minimization kind of comments he's given on why he left the hedge fund world where he was making good money to go start Amazon at the time when the internet was exploding. For me, it wasn't so much as noticing a trend that was exploding like he did with the internet, but it was more just realizing that I've been studying good managers who've managed portfolios themselves, whether it's a public company portfolio like Warren Buffett or hedge fund managers over the course of my life, and always respecting what they did and always wanting to be able to kind of practice the art myself one day, and knowing that I was young enough to take that bet at the time, where if it didn't work out, I wouldn't harm myself too much. And if it did work out, I would be very happy that I was able to follow in those footsteps and practice the art that I'd been studying for so long and was so passionate about. I had no kids, no mortgage, wasn't married yet. And so the ability to take that risk on myself, there's in this industry, there's basically two ways to go out on your own. One is when you're young and kind of your risk appetite is fairly high. You don't have a lot of AUM and you kind of scale it the hard way. The other way is you've already made it in this industry and you could put $100 million of your own money and everyone else follows you with a few billion of outside capital. Um, I thought I was on that trajectory not to be able to pursue that latter one. And so the former one was really the only one I had. And the clock was ticking because I did want to get married and have kids at some point. And so, I eventually I took the shot on myself and I'm glad it worked out.
So, you came from a background in private equity, but, we're talking about managing fund in public equity. So, talk about, what gave you the inclination to go for public equity
Yeah,
markets.
so I started my investing career at a private equity firm called HIG Capital and their leverage buyout group. From there, I moved to the public markets and I did work for two public long short value hedge funds. And uh, I thought very highly of the people I worked for, very smart. Um, but there were lots of things that I thought I would do differently if I was running a portfolio myself. And I was talking to lots of friends and colleagues, right, at idea sharing dinners and just actual friends about the funds they were working for. And everyone had ideas on what they would do differently than their PM and why they thought their PM was doing this wrong or that wrong. And so I realized that like it's very easy to talk a big game and say what you would do differently and what that you think others are doing wrong. It's much harder to do that thing yourself. And I thought I had what it took, but I kind of wanted to see for myself. And so if I was going to fail, I wanted to fail early. And that's what gave me the kind of confidence or chutzpah to kind of go out on my own, is to think, to always be thinking what I would do different and better. And I think I got this, but then can you actually walk the walk? And so I took that shot on myself. And again, I'm very happy it worked out the way it did.
So, what are some of those biggest differences that you were observing from the start?
So I won't talk specifically to the former places I worked for, but just in general, what me and my friends and colleagues were saying about the PMs they were working for, the funds they were working for. It's not uncommon to hear someone saying that, you like buying charts that are going up, so you're buying top of momentum and selling things as they go down instead of the opposite. If you really know what you own, and you're confident in the conviction in the analysis you did, and you have conviction, you should be buying drawdowns and selling things, as they go up a lot. And I think a lot of times PMs in this industry, they're not that confident. They get disconnected from the idea generation and research process. So their conviction is reliant on momentum and other investors telling them that their analyst is right. And so I think they tend to do the opposite. Same with taking your net up or down. People tend to take their net down after a 5% drawdown and take your net up after the market breaks out to new highs. I think that should be the opposite. I think a lot of times from marketing perspective, from a marketing perspective, you might pitch that to LPs that you are good at finding turnarounds or hairy situations that are going to become less hairy, and that's what's going to deliver multiple expansion. I've always thought that hairy situations tend to stay hairy, and good management teams and good businesses tend to continue. Momentum is a very powerful force in this world, and if a business has strong underlying momentum and management has shown that they're good capital allocators over time, I'd rather bet on that horse than catching a falling knife. And so the framework I wanted to take to being a value investor was finding cheap businesses that have executed, but have derated over that execution process. So I like GARP investments at value prices. Um, and I've been more hesitant to buy turnarounds at cheap prices. I'm not trying to buy names that are reliant on multiple expansion to do well, but names that are worthy of multiple expansion if I'm right on my analysis. So just little things like that, each one of them might not sound that significant on its own, but like when you put them all together, that becomes the way you manage your portfolio and it's unique to you. And this is asset management it's an interesting business where you could have a scaled asset manager or kind of a subscale artist or practitioner of investing as an artist. And one man capital is definitely that latter type. And, I like to practice my art the way I want to practice it. A lot of times people in this industry, when they do go off on their own, even if they're making a lot of money elsewhere, it's because they want to be the artist. They want to paint their own painting. And so that definitely resonates with me as well.
It's interesting to think about one of the contrasts in what you said about what people do wrong, or
I'm not saying it's wrong. It's just what I would do differently. I mean, there's no
yeah,
right. Yeah.
sorry, wrong word
If someone's
there.
if someone's able to make money with a strategy, then it's not wrong. But sometimes I would just do something differently if I was running the strategy. So
Right. So I'd contrast what you said about most PMs are buying charts that go up and want momentum in their businesses, but they also really like buying turnarounds. So in the fundamentals, they're being contrarian. In the chart, they're being a momentum chaser.
hmm
And so I think there's an interesting contrast in how you phrased those two, juxtapose them next to one another there.
Yeah. Look, again, this is just comments I've heard from different people in the industry a long time. And I'm not saying every PM does the same things that I would do differently. I definitely try to take some things from a lot of people and avoid some things I've seen a lot of people do. Um, I think that, the best way to figure out what works for you is to read a lot of different philosophies and strategies and figure out what works best for your personality, for your mindset, for the way you view the world, for your life experiences, right? And so, in terms of sizing, in terms of risk management, in terms of risk appetite, in terms of whether you buy momentum or sell momentum, I think that there's lots of ways to skin the cat in this business. If you find a way to make money consistently without going too far out on the risk curve and it works for you, that's great. You found your art. You found your, right? How many different types of paintings could there be? Artists, right? There's contemporary, there's whatever. So, that's kind of how I think about investing as well.
Yeah, you've talked a bit about putting yourself, I follow you on Twitter, and in times when the S&P gets beaten down, you talk a lot about, knowing what you own and having the ability to see through your best ideas. Maybe talk about that, how that's been to execute on in reality, and like how you think about managing the kind of mental side, the client side, and putting yourself in position to succeed and come out of drawdowns in a better position.
Yeah, it's very important to know what you own and and know how you're going to behave in certain situations. And so again, in terms of position sizing, net exposure, gross exposure, I think what works for one does not work for all. Um, it's not just about being right on an investment. It's about being right on the investment and seeing it through. I tweeted once a long time ago, I don't remember exactly when, but I think it was a while ago that, sometimes people buy something that has a, a low risk of significant impairment. And they're like, well, this is a low risk of significant impairment. But that on itself doesn't mean you should make that investment, because if a stock starts to go down and in your mind you think that means the risk of the significant impairment is higher and you end up selling, all it takes is for the odds in your mind to go up because you didn't know what you owned to exit. And then you didn't get from point A to point C, you exited at point B and you stopped yourself out at a loss. And so I do think you need to be able to see through your investments, and you really need to know what you own if you're going to see them through, because that means going through drawdowns. And when you're in a drawdown, if you're not cutting and running, you do risk that drawdown continuing, right? And eventually it being permanently impaired on your capital. I think having conviction in what you own is important, but not unnecessarily high conviction, right? You could have delusion too. Conviction could be delusional, or it could be based on sound fundamental analysis. And so you need to have humility to know that you might not know everything, but conviction to know that you know enough. And you need to be able to change your mind if the facts change. It's a very tough balance. There's not that many, there aren't that many of the greatest investors out there for a reason.
So maybe talk me through like today's environment. I just came from Lattice Work by Manual of Ideas, saw John, and it was a great week. And I thought there was a really interesting contrast between Ed Wachenheim was interviewed just before Bob Robotti. And I think both of them are kind of like elder statesmen in our craft, in this art of investing. And I think they look for, at the end of the day, pretty similar stocks to one another. But Ed talked about the S&P being in the high 20s on a PE ratio, when 16.5 has been the normal number over the last number of decades, and how, as a consequence, he's sitting in 45% cash. He has a few core ideas that he really likes, but by and large, a good chunk of the portfolio is sitting in cash, as much as it's been in a long time. And then Bob Robotti, on the other hand, is he kind of reflected similarly on Ed Wachenheim on the broader environment, but said that his opportunity set, the kinds of ideas he looks for, have never been in such abundance in recent times, and he's very excited by what he sees. And you hear that passion ooze through Bob's conversations. And I was just curious your thought. Like, how do you think about this environment? How much does macro infuse your thinking? How much does the general context of where the S&P is, the concentration of the S&P, right? 10 largest companies are 40% of the index. Like, how do
Yeah.
these things
Yeah,
get?
that's you put a lot out there. I think, look, as an active manager, you don't own the market, you own your portfolio. And so to the extent you could find a portfolio of assets that are significantly undervalued, that are generating cash, reinvesting that cash wisely and growing their value over time, I think you're less exposed, right? There could be some macro risk in your portfolio, but in general, it should be accreting value, and you should eventually be confident or hopeful that you can get multiple expansion on top of that value accretion. And so I don't think flexing cash up and down based on the multiple of the S&P makes a lot of sense. Now, flexing your cash up and down based on not being able to find those types of compelling opportunities makes a lot of sense to me. And then the other thing is, even if you were to take the view that the S&P is overvalued, I think timing is very important in this business also. Like, something could stay overvalued for a long time. It can go from overvalued to undervalued by outgrowing, right, into that. It can grow into that valuation. And so taking a view that something will correct instead of appreciate more slowly in an era where it's growing earnings more quickly, right? If the S&P goes up 3% a year, but earnings are going up 15% a year for the next few years, like, by being in cash, you're still giving up on 3% a year. Now, the return on cash should be higher than that. So you wouldn't be that upset, but that's just kind of giving you an example of, you have to get timing right if you're going to go short the market, not just the overvaluation piece. And we are sitting here in an environment where, fiscal deficits are still very high. This AI CapEx boom should go on, who knows for how long, but it seems to be durable for now. And that leads to a lot of economic activity that should support the biggest companies that have exposure to that. So I agree that the multiple of the S&P seems high. I'm not dying to buy the S&P. There are a lot of smaller businesses that I own in my portfolio where the multiple is not high or demanding at all, that are generating cash, deploying that cash smartly, and I think are accreting value, plus should get multiple expansion. And so my cash would flex up and down if I couldn't find those opportunities, not based on where I think the S&P multiple is. But I agree with the sentiment. The S&P multiple does appear high. I do worry about what happens if the US government does get its act together, ha ha ha, and cut deficits, which isn't happening, or if the capex boom for AI does somehow slow down, which doesn't seem like it's happening yet, but who knows? Um, what would happen to the S&P in that environment, and the knock-on effects of a down S&P, negative wealth effect, what that could do to the real economy, which my businesses are exposed to, but I own businesses with good balance sheets. And, if their stocks get hit on a cyclical downturn, hopefully they're more aggressive on acquisitions and buybacks and accreting their value at an even faster clip, such that when the recession inevitably ends, which they always do, the eventual per share value will be even higher. So I'm comfortable with drawdowns because I know what I own. It's good balance sheets, and I'm not going to get scared out of my positions. And my companies are not going to go bankrupt or have to issue expensive debt or equity in those downturns. So I know I'm confident that I'll come out the other side better if it were to happen. And that's why I'm comfortable with drawdowns. But not everyone is. Not everyone knows what they own. Not everyone owns things that could survive and thrive coming out of a downturn. And some people need money tomorrow and they can't afford to have a mark-to-market drawdown, or they don't have LPs that would allow them to have a mark-to-market drawdown, or they have a leverage structure where they can't afford, so everyone has to do what works for them as an investor or portfolio manager. That's just kind of how I manage my portfolio and how I see things. Um, I don't know if
And
that makes
speaking of
sense. If that makes sense.
on drawdowns, right? Earlier this year, the S&P had a pretty significant drawdown. It was one of the more severe drawdowns in recent time. It seems like a distant memory as we're recording this in early October, but how were you thinking about this particular drawdown where it wasn't so much about what cyclical risks your companies faced, but about the gamemanship and brinksmanship of kind of international trade relations and negotiations and the sentiments of one person in particular?
Um, I at the time I tweeted this out as well. Uh, the more the market went down, the more likely there was going to be society does not like bad economies and bad stock markets, right? Societies in democracy, right? And maybe in China, if the government decides to do something that is bad for business and stock prices, but they decide it's for the greater good of the country, they could do it and they could tell everyone, eat it. Stock market sucks, but this is part of our long-term plan. In Western democracies, it's a game that's rigged for profits and stock prices and for the economy to just go up and to the right, and the more that doesn't happen, the more pain people feel, the more likely they are to pressure their elected representatives, who then change policy. And so I was of the view that as confusing and unproductive as the Liberation Day announcement was that led to that sell-off, I thought the more the market went down, the more likely it was to be reversed. And I own business with good balance sheets. And so like they could stomach that reversal and wait it out. And I definitely had some more cyclical-ish exposure in the portfolio that I traded out of at that time. Um, I do generally, and I think most investors, portfolio managers probably should agree with this at least, is that it's much more fun when your stocks are going down, when there's lots of other stocks going down around you, because it becomes less painful and less costly to rotate your portfolio around. So I generally like when the market corrects 5 or 10% a few times a year. I think it creates opportunity. I always have some names in the portfolio that I think went down for the wrong reasons and some names that I think are going down for the right reasons. And it does create an opportunity to rebalance without the pain. The worst thing is you have a position going down 20% for an idiosyncratic reason to that business and you change your mind on it, and it's harder to find a replacement where you have a sufficiently high IRR to offset that type of loss in that one position. But when there's drawdowns of the entire market, I think it's much easier to rotate the portfolio, and that's what I feel like I did.
Yeah, that's a really interesting thought too, because like coming out of lattice work, again, one of the themes I think I picked up on from several people there was this idea that, the last couple months, the market had been plowing ahead relentlessly. Meanwhile, there are many stocks making new 6-month lows, year-to-date lows, 52-week lows, and there's a lot of pockets where there's just not this enthusiasm. Like things that are consumer centric right now seem to be especially weak, but everything AI seems to be going parabolic. So, like,
Hmm.
how do you feel about that contrast? How much do you think about AI generally in any sense?
I think about it a lot. Look, I think we're right. We've had a rate hiking cycle. It's dampened consumer demand. It's dampened employment. Wage growth has slowed down. Um, there's still some inflation in some categories that represent a significant portion of people's spending. So, right. So like lower wage growth, but still high housing prices. And so, it's not that surprising to me that consumer discretionary has been in the gutter. Um, and then you factor that in with a period where consumer spending and expectations of consumer discretionary spending were extremely bullish coming out of COVID with helicopter money and free money. And and consumer discretionary is a very pro, right? There's a lot of fragmentation in the types of things that goods and services that businesses make to cater to consumer discretionary services. So it's very pro-cyclical, meaning when consumers have a lot of money and when businesses expect consumers to spend a lot, roaring 20s coming out of COVID, there's a lot of capacity added and a lot of competition introduced. So in an environment where you have pullback on consumer discretionary spending because of higher rates, because of slower wage growth, and because of non-discretionary things still inflating. And in conjunction with a lot of capacity having come online coming out of COVID, it's not surprising to me to see margins and businesses who cater to that struggling over that period. And then the stock prices for a lot of consumer discretionary in particular, there are a lot of secular question marks. I'm not saying definite secular headwinds, but a lot of question marks that could create opportunity for some investors if they have conviction that this is the wrong take. But, you know, the options for in-home and out-of-home entertainment in a digital world are just endless. And so in a world where people needed to seek a few alternatives for out-of-home or in-home entertainment, now they have an endless number of those things. And so the second you see a business seeing same-store sales decline or revenue decline, you start to wonder, man, is this secular or cyclical? And that's when multiples get really hit also. So, if there were no secular question marks around some of these businesses, you would expect the multiple to go up as earnings went down because people expect a cyclical recovery, right? So higher multiple on lower earnings. But you get both going down together, the earnings and the multiple, because people all of a sudden wonder about that. And so I think that creates opportunity. It creates opportunity to make money if you pick the right ones, or to lose money if you get the wrong ones and make the wrong bets. Um, and then with I think about that a lot, how it's going to impact every one of my portfolio companies. I think it's a big change. I think in general, good businesses will be helped by AI over time, and bad businesses won't be helped by AI over time. Not necessarily. There are some businesses that will just be hurt by AI over time as well. So there's kind of like three buckets is the way I think about it. If you think of a good business, right, with a moat and pricing power, AI should increase the productivity of their workforce. And that means their costs will go down and they don't have to pass on that cost reduction to their customers because they have a moat. And so they can keep pricing as is with lower costs. And that means they should earn higher margins and higher returns on capital. And examples of that could be like a Moody's or an S&P, right? Like if you can rely on computers to do credit ratings, but you don't have to lower pricing to issuers, you could have higher margin and retain that higher margin to yourself. And that's incredible for your owners, or Visa and MasterCard, right? To process payments or whatever. If you have a commoditized business with lots of players, right? Very fragmented, yeah, the cost of delivering that good or service might go down, but everyone's competing on price. So they're going to pass along that lower price to their customers to retain their market share. And so consumers will benefit from consumer surplus associated with more efficient cost structure. And then you have businesses that like are literally going to be replaced by computers. And I think those will suffer. And that could be like an IT staffing business, right? That used to like rent employees to help fill IT jobs or coding jobs on an as needed basis. But now companies no longer need to flex up and down their coders because their existing coders are becoming more and more productive every year because they're using AI tools to improve their coding. And so like that business might just be disintermediated completely. Obviously, in my order of preference is to own more of the best, the ones that are going to have higher margins because of this and retain that surplus for themselves. I'm fine with businesses where the consumer surplus gets passed along to the end customer, but in general, those are lower quality businesses. So like I defer to higher quality businesses, but I think those are fine. I think the ones you really want to avoid is being especially concentrated a concentrated investor like me as being in the ones that are going to be disintermediated completely. And I think it's very important to avoid those because those businesses could go away. And, if you buy them sufficiently cheap, you could still do okay, but capital allocation becomes extremely important. The last thing you want is a CEO who goes to lever up to buy a competitor to get some cost synergies in a melting industry, or who buys levers up to buy back stock in a company and does the levered buyback model into something that's a rapidly melting ice cube. So if they do dividends, if they buy stuff in other industries, you're really relying on capital allocation at that point. And those are the ones I'm trying to avoid.
So yeah, on that first bucket, it's kind of interesting you mentioned S&P and Moody's today, given those have had a rough little stretch of late with, I guess, emergent fears that maybe AI could lead to alternative paths for validating the creditworthiness of
Yeah,
certain borrowers.
you're always gonna have question marks around new technologies disrupting something. But if you have a moat, which it seems like they do, I think eventually you prove out that that moat has been durable, and your shareholders who were able to hold on for that period. If you get shaken out, again, you have to get from point A to point C. If you get shaken out on point B, that doesn't work. But I think I'm not saying that they're definitely going to be able to defend their moat, but they have proven through many different environments that their moat is very wide. I expect them to do everything they can to defend it and protect it. And to the extent they're able to do that, I think they're not going to have to cut pricing, and their shareholders will benefit long term. I'm just giving examples of the types of businesses that I think should benefit. I'm not saying those specifically will. I don't own them. They're not cheap enough for me. But if they were trading at the multiples that I like buying stuff at, it's definitely a business I could see owning because I think they're more likely to benefit than to be harmed by AI. I think there's still franchise value there. And I think they add a lot of value to issuers and to investors. I think they're and relative, and they don't really cost all that much in terms of the interest savings you get from having rated debt.
Yeah, I just thought it was interesting. In particular, of late, there's been this big sell-off in some of the IT companies. Both some in the third bucket you'd mentioned that might be disintermediated, but also the first bucket. And there's been maybe a baby with bathwater effect going on. But maybe to your point, they'd all started with fairly similar high multiples, like 30x earnings or higher in some cases. Talk about the multiples that you do like seeing, like what, and maybe it's a good opportunity to talk about what gets an idea into the very top of your funnel, where it's something that you decide I want to learn about this, and I may or may not make it a position in the future, but I'm going to at least put it through my process.
Yeah, so my funnel is very wide, but I throw out a lot of stuff very quickly. I typically, you know, a lot of investors use the private equity approach in public markets, but then you look at their portfolio and it doesn't seem to jive with the private equity approach in public markets. I really try to take the private equity approach in public markets, which means I try to throw out businesses that I'm not comfortable owning forever if the market closed tomorrow, right? So, um, commoditized businesses, highly leveraged banks, opaque financial institutions, businesses that have a big patent cliff that it's unclear whether they're going to be able to defend their proprietary technology or service or whatever. Um, Significant customer content, or if you have 30% customer or a sole source supplier or huge regulatory risk or disintermediation risk. So it's very easy for me to throw a bunch of stuff out. What ends up is a compilation of businesses that I think have diversified customers, diversified suppliers, no regulatory risk, very little disintermediation risk. I tend to throw out businesses that don't have enough insider ownership because it's very easy to incentivize a CEO to try to get the stock up a lot through options. It's very hard to cause pain to a CEO if a stock underperforms or goes down in value unless they own a lot of stock.
Yeah, heads I
And
win, tails I don't lose.
yeah, and I don't want them just to be motivated for upside. I want them to suffer with me if I'm suffering. Not because I want people to suffer, but just because incentives drive outcomes a lot of times,
You want to
and
be aligned.
I want to be aligned exactly. So if there's not sufficient insider ownership, if the balance sheet is not sufficiently healthy, I don't like leverage businesses. And a leverage business could be defined, differently for different end market, right? Like I owned a dental roll up and I bought them when they were 4 times levered, very little capex. and almost no economic sensitivity. So like to me, that felt like a healthy-ish enough balance sheet for a very economically insensitive business. Um, Obviously, for a much more cyclical business, um, or one where capex eats up more EBITDA, like I would demand lower leverage ratios. But if the balance sheet for that type of business is insufficient for me to feel like there's a large margin of safety through a potential cyclical downturn, it might fall further down the watch list, or I might kick it off entirely. So I go through this quick checklist that for me is quick. It might take others longer until they do what I've done for a while. And I say no to a lot of things, and then things make their way onto the this is investable. Once something is investable, I'm very valuation focused and IRR focused. So the things with the highest potential 3 to 5 year IRR make their way up the watch list, and things with the lowest potential 3 to 5 year IRR move their way down the watch list, with the understanding that my confidence in that IRR also helps things move up the watch list. So two things that have a 25% 3 year IRR, but one I'm very confident in and one I'm not, it might end up in different parts of the watch list. And my confidence in that IRR stems from stability of the business, stability of the predictability of the end market, my confidence in management and their ability to execute and deploy capital in smart ways, and just time and time understanding, like the amount of time I've studied a business for, the more confident I am in that business and management team. And then the last thing is price, right? So like the IRR of an investment could go down. My expected IRR for investment could go down as I increase conviction to take my out year numbers up or my out year multiple up, or a cheaper entry price, right? So like, if a stock price is flat, but I take my out year numbers up and I have more conviction in them, my IRR goes up. If a stock is down, but none of my assumptions or out year multiple change, the IRR goes up. So there's two ways things move their way up the watch list: time and confidence, or decline in price. And then I force rank all those positions against each other. Um, the highest IRR with the highest confidence in that outcome wins and makes its way and grows up and moves up the portfolio in terms of sizing. Um, and that's kind of how I do it. There's lots of things on the watch list that have fallen far enough down the watch list where I might not be up to speed on them at the moment, but I can get up to speed on them very quickly because I've already kind of done the work, and I might be stale, but it's much easier for me to get back up to speed and gain conviction in those types of names than ones that I'm brand new to. And then there's names that I've been following very closely for a long time that I'm already up to speed on. And so, um, yeah, it's an art, there's no two people will have an identical portfolio for that reason. So
Unless they're all in the S&P.
correct.
But very few ideas make it through the very bottom of your funnel, right? So you're extremely concentrated, as I'd mentioned in the beginning. Maybe talk me through, is that an outcome of something, or is that a specific idea that you'd had from the beginning? Let's be very
Yes.
concentrated. And how do you think
So
about the
I wouldn't
right
say I'm
balance?
extremely concentrated, but I'm concentrated. Right? Extreme concentration is like a 50 or 70 or 90% position. My big positions tend to be like mid-teens, high teens at cost, maybe 20-ish, but like that's rare. And then I'll let them run. Okay. So, um, I do like momentum. Everyone likes momentum. It means the market's telling you things are working, the business is telling you things are working, and when things are working, they tend to work. There's a reason why momentum is a factor. Lots of quant funds and quantity type investors spend a lot of time focusing on because
And it's the
it's a real
best factor
thing,
of the last 2 years by far. So
and probably over the last 30 years, to be honest.
momentum in momentum.
So everyone likes momentum. I do let my winners run. I've had things get up to 25 or 30% of the portfolio while they're working before I start trimming them back. Um, but in general, right, I'm putting 10% of the fund in something and a good idea. Maybe if it's a really good idea, 15% of the fund. And then the types of businesses I buy tend to be, hopefully in growing industries that have some secular tailwinds to them and very well diversified across their customer base. So like you could have a 5% position in a company that has a 50% customer, and that's not that, right? You might think that's not that big of a position, or you could have a 20% position in something that has the biggest customer is 0.001% of sales and is not economically sensitive, and people will get their cavity filled no matter what. And is that really that concentrated to have like a 20% position in a dental practice with literally millions of customers and thousands of dentists And like, is that concentrated? I don't know. Like, of course, there's fraud risk or something, and that's why I don't put on 50% positions at cost or 30% positions at cost. Um, but I don't think I'm like uber concentrated. I do think the types of names I look for that check all those boxes, good business, growing end market, hopefully secular tailwinds, consolidating end market or already consolidated. So like either an oligopoly, a few players control a big chunk of the market, or it's fragmented but consolidating, and I own a consolidator that's able to buy things at attractive prices. Um, and so to buy those types of growing businesses with good management, aligned management, good balance sheet at the types of multiples I'm looking to pay, which are typically I'm looking to buy stuff at like 10 times free cash flow or less. Like maybe I'll buy something at 11 or 12, but like I really prefer to buy something at 8 or 9 or 7, right? And a business that I think is worthy of 15 or 20 or 25 and is growing earnings. And so like I'll get the earnings growth and the multiple expansion if I'm right. And it's just hard to find that combination. And so you need to have some level of, right. It's impossible to find 20. It's not impossible, but if I had 20 of those ideas that checked all those boxes with very high, forward IRRs, I would have, a 20, I would have 20 equal weighted longs. But typically, you're trying to solve for having all those qualities and a low enough price to justify a sufficiently high IRR. And then you end up with some that you think are really, really good, and you want to have as much capital in those as you feel comfortable having, from a risk management standpoint. And so that's how I end up with big positions.
Yeah, so let's talk about the biggest position in your portfolio today. It's a big bet. I own it too, in full disclosure. It's IWG. I'd suggest you all listen to the deep dive that Yaron did on Andrew Walker's Yet Another Value podcast. So we're not necessarily going to go fully deep in it, but I'd be curious to hear you talk about evolutions in your thesis, maybe the quick distilled version of why you found this so appealing and how you see it shaping up versus what you'd outlined in the past.
Yeah. So, International Workplace Group, they're the largest co-working company in the world, approaching 5,000 locations globally. Most people have heard of WeWork before they've heard of IWG, which owns IWG owns the Regis brand. That's their biggest brand. I was a WeWork when I started One Man Capital in 2018. I was a WeWork customer. Today, I'm a Regis IWG customer because I moved to the burbs and WeWork doesn't have exposure in the
And
burbs.
I'd add a personal bit of history here. The very first thing I did as an out of school professional person was sign a contract with Regis. So I was very
Nice.
familiar with that for over 20 years. But go ahead.
Um,
Sorry, I
yeah, so I
digress.
was I was familiar with the business from my time as a customer, from my curiosity around the whole WeWork saga, right? I read their S1. I was like, man, this is a bad business. They've never made money. They sign corporate guarantees on their leases, big lease liability with corporate guarantees. Like, how are they worth $30 billion? Um, and then I saw it implode, and and that was my first experience with co-working. So I did come into IWG, I would say, as a skeptic a little bit, but I peeled back the onion and I noticed a lot of interesting differences. I mean, the biggest one and the most glaring one to me was that Mark Dixon, who's the founder and CEO, was able to take this to like 4,000 locations at the time and hold on to it. At the time, he owned 30% of the company, and it was a very clean balance sheet. And so I was like, man, how does a founder of a company hold on to 30% of a company? And by the way, at the time, he had sold a few $100 million of stock over the course of time as well, right? So the guy sold a few $100 million worth of stock. He's built it to 4,000 locations. It has a clean balance sheet. Like, doesn't that imply that there have been good unit economics? Because if the unit economics are bad, you dilute yourself into oblivion, raising equity, or you lever up the balance sheet and you're over leveraged in order to grow. If you have bad unit economics, the only way you can grow is issuing lots of equity or borrowing a lot of money. So you end up either levered or diluted. And so, one of my mental models is like whenever you see an insider owning a very big chunk of a company that's big and the company's not levered, you have to ask yourself, how did he get there? Was the stock gifted to him in some way? Did he get a bunch of options from a crook board that just like gave the company to him? Or does this business have good unit economics? So my spidey senses go up in a good way when I see high insider ownership with a clean balance sheet. And then, I started peeling back the onion and noticed that unlike WeWork that had signs corporate guarantees, IWG has segregated leases, right? And I was like, man, like that takes your lease liability from being a liability to being an asset. Because if you have 4,000 locations and each one of them is non-recourse to the parent, then in markets where there's excess demand, you benefit from having a fixed lease expense and you could take pricing up. And in markets where there's weak demand, right? You make less and less money. Eventually, you go back to the landlord and say, "I'm going to walk away from this lease unless you lower my lease expense." So you benefit from margin expansion in markets with excess demand, and you could always go back and return it back to like a fair deal in the ones where demand is weak. And they've done that multiple times over downturns, right? Coming out of COVID, I think they've probably restructured half of their leases coming out of COVID. Because in good markets, they took prices up and made more money, and in bad markets, they went to the landlord and said, "You have to work with me or I'm going to walk." So better business, good unit economics. Um, and the way they had good unit economics relative to WeWork is they signed cheap leases and they ran these things for margin, right? They didn't provide free beer and put a ton of CapEx into them. They actually ran them like a business. And so good after-tax unit economics in terms of return on invested capital, um, good lease structure, and it was cheap for a variety of reasons that I started to like identify one by one. And I started to disprove each of them for being a reason why this should be cheap. Um, and and then I found out about this management business that I was like super excited about. And the management business was a business transformation, which whenever you could find a cheap business that's growing, that's cheap for the wrong reasons, but has this like hidden gem of a business inside of it that's not that meaningful today, but you know will be meaningful at some point in the future. That's a great setup. And this had that. And they're adding 1,000 They had a few hundred of these managed locations coming into COVID. They're adding about 1,000 a year right now, where they put up no capex anymore. There are old locations they used to put up the capex themselves, sign a lease, earn the spread between what they could rent the locations for and what they were paying in lease expense to the landlords. The new locations, they don't sign a lease, they sign a management agreement. They take 15% of revenues. They put up no capex. And that business is small today, but is going to be very large in the future because of the pace that they're adding these at. And to give you a sense, 1,000 a year they're adding. WeWork has 500. They say in some places they say 500, in some places they say 600, but between 500 and 600 locations around the world for WeWork in total. The number three player, Industrious, has probably 200. Maybe they're approaching 300 now. We're adding 1,000 a year managed. Okay, we're adding multiples of the next largest players combined every year, and that will be a very big business worthy of a very high multiple. And I thought the business on its own was worth more than what we were buying it for. But this management agreement business was going to be worth many multiples of what we were buying it for. And so when you could find a good balance sheet with high insider ownership, cheap, diversified, right? Like thousands of locations, millions of customers, um, with a lot of growth, and the growth mainly from a cap light, high margin, non-economically sensitive revenue stream, right? It's more revenue than there's the costs because you don't have the operating leverage of the lease expense. I think that's a great combo. And so like I made it big over time. Now it started out probably as a 5% position. And as I was doing more work and getting more comfortable and I was flying to London to meet with the management team and I met with them more and I spoke to them more and I spoke to more building owners and spoke to competitors at the various competitors and spoke to former employees. Like as I did all the work, it became bigger and bigger. And oh, it didn't hurt that there was um, a big shareholder that was getting redemptions that was like a forced seller into this environment. And I was able to reach out to them and talk to them and figure out that they still love this name and it was paining them to have to sell, but they were getting redemption, so they had to sell. So like as I was gaining my conviction, stock price was going down, not up, due to non-economic selling pressure from a large shareholder that was getting redemptions. It was like the perfect storm. So I just kept adding to it, and that's how it became so big. And I feel really excited about now. The stock price finally has some momentum now, um, and I'm really excited about what the next year or two brings for this one. So
So on that redemption point, right? We'd done a series on this podcast on the opportunity in UK-based small caps. UK-based small caps are maybe one of the most unloved asset classes in the entire world. And it raises, one of the bear cases that I'd encountered when I first started looking at this company was a degree of skepticism from UK investors about Mark Dixon's past, about lines like he'd chased every trend, that, he'd made promises that he didn't deliver on in the past. And these things led to a degree of reservation from, I'd say, the masses in London. And it raises an interesting point that we maybe didn't discuss on your approach, but looking globally and looking for opportunities where there's kind of this disconnect. It is a global business. There's a really big U.S. presence, but the price is set by people, by and large, in the UK. So, just curious your thoughts on that bear case in particular,
Yeah.
and how you think about the opportunity going across the Atlantic for a company who's actually in the middle of converting their financials to GAAP accounting.
Yeah. Look, in terms of chasing every trend, I want a CEO who's willing to chase big TAMs if he thinks he has a good business case to make at those TAMs, right? And at risk of quoting Bezos one too many times on this podcast, um,
It's all right. We
his
quote Buffett a lot here, so you could quote
yeah, but
Bezos.
like in baseball, like the most you could hit is like a home run, and in business, sometimes you could hit 1,000 runs from one investment. Um, and so like it does make sense in that context to sometimes make improbable investments in outcomes that could be exceptional if they work. And so like I would never blame a CEO if there's good logic and sound logic to to chasing a new trend. I would never blame a CEO for doing that. I do think in public markets, especially, you have to be very careful what you tell and promise to investors because you will be held accountable for the promises you make. And some investors are given the benefit of the doubt, right? If you think about investors in Tesla, they give Elon Musk a lot of benefit of the doubt. But in general, like outside of being careful what you say, I do want managers who are willing to dream big if the payoff is sufficient to justify taking a risk. And I think Mark has enough skin in the game that he's earned the right to potentially chase new trends. And not every one of them will work. But if some of them do, this management agreement model is going to be a great example. If this works, this company will be worth many, many, many multiples of the current share price. Do your own diligence. This is not investment advice. You might lose all your money if you make this investment. But like, in my opinion, the reason why I have a big position is because I think it will work and there will be the opportunity to make many multiples of our money here. And um, I spoke to investors who told me don't believe anything he tells you because he's made lots of promises and they haven't panned out. The beauty of this management agreement model was I was able to go chase down building owners and speak to them and confirm that they were actually doing it, that they were actually doing it under the terms that the company was telling me they were signing these agreements at, and that they were sufficiently happy such that they were going to sign more of these agreements. And so like I didn't need to take his word to the bank. I was able to go verify. And so like that's a great example of like if you're going to believe a CEO when he promises you X 3 times in a row when you can't verify it and you get burned because it doesn't pan out, but then the fourth time you're just like, I don't believe anything he says, even though that's the one thing you could go out and verify, then that's a potential reason why an opportunity might exist. And that created an opportunity here. I think there were, and in terms of the promises he made, there were a few of them that I thought were all justified promises. And maybe, you know, he didn't actually believe the timeline at which he said them, but I think he generally believed the things he said. Maybe he thought they were going to take longer. I don't think he was actually just trying to lie to investors. I think he was trying to build an, he's trying to motivate his team to think big. He's trying to tell his shareholders that he's thinking big. And then there were some things outside of his control, like the sale of the US business potentially, like the Japan, people who are familiar with the company know that they were trying to actually sell their locations in the US and retain a royalty on those locations. But I think the reason that didn't pan out is understandable, right? You had WeWork trading at a very big valuation that provided a valuation umbrella for the US assets. And then WeWork imploded. And so that valuation umbrella went away. And we're not going to give away our US businesses, the business that generates a lot of cash for free just to have a royalty on it. Like right now, we get all the earnings from those locations. Why should we give away a big chunk of those earnings for free or for a low multiple just to say we're asset light? And so I don't know. I think the managed business clearly has product market fit. They're crushing it. I think it's going to create a lot of value. The owned locations we continue to operate for cash, and they're doing well as well. I don't think he's perfect. I think he's made mistakes and he will continue to make mistakes, but we're all human. And if I tell people, if my LPs redeemed for me every time I made a mistake or got a stock wrong, I would have no LPs left. And so it's interesting to me that portfolio managers who make a lot of mistakes in their portfolio don't give leeway to CEOs or managers who make mistakes in their business. Like it's going to happen. When you make lots of decisions, you're going to make mistakes. You just have to think, am I aligned with them? And do I think they generally have good judgment and make informed decisions at the moment that they make them, knowing that some of them won't work out? And I think I could check all those boxes with Mark.
Yeah, no, I think that's a really interesting point because, when you think about how they could have gone asset light in the US much sooner, the reality is, had WeWork not imploded at that time, the reality is they're in a much better place. They're going about asset light in an even better way that will be more
Hmm.
value accretive long term if managed works out as hoped. And you'd mentioned the non-recourse at the parent level of each of the individual leases they signed for their locations. If I understand right, that was a consequence of a mistake having been made coming out of the dot-com bubble. So Mark
Correct.
clearly,
Going into
he
the
learned
dot-com
his
bubble.
lesson. What's
Yeah.
that?
Going into the dot-com bubble.
Right, right. So he learned his
Yeah.
lesson the right way.
Yeah.
Well, sorry, he took the right lesson out of a very bad situation.
And by the way, he was on CNBC telling everyone WeWork is making the same mistakes. WeWork could have studied the mistakes that IWG made and probably avoided some of them, but their incentives were to grow at all costs. So that's what they did. SoftBank incentivized them to grow at all costs, and so they lived up to their incentive structure. So like I will say like selling the US, understandable mistake for me. I understand people who got involved for that were disappointed it didn't happen. Promising that transition to cap light more quickly and talking about 30,000 locations or whatever was like not necessary because when you're at a few thousand locations, you don't need to talk about 30,000. You could talk about 5,000 and people will be very happy. And then when you're at 5,000, you could talk about 10,000, people will be very happy. But like you don't need to overpromise on location count. You don't need to promise on how quickly you're going to get to capital light as a mix as a percentage of your business unless you have a ton of confidence and visibility. But like those don't bother me at all. I do think there was overpayment for an acquisition, the Instant Group, in 2022 before I got involved. And that on its own, okay, people like in 2021 and early 2022, lots of people were living in la la land in terms of what businesses were worth, including me and you and every other probably investor. And lots of people lost money by overpaying for stuff. And it was a clean enough balance sheet for this company that he didn't risk the firm to make the bet, but it was unfortunate. I think that sometimes they have repercussions though, right? Like having done that, I think he was a little gun shy when it came time when WeWork was going bankrupt last year. I do think there was an opportunity to potentially steal a valuable brand and franchise for a very attractive price. It had we hired like a Houlihan Lokey or an Evercore or someone and been like, go figure out which bonds are the fulcrum security and what we need to pay to own those, or even once the bankruptcy process began to say we'll pay X to take the company out of bankruptcy, there might have been the opportunity to do that. I don't know how much of us not doing that was like him being gun shy after having overpaid potentially for instant. And then like it sucks. Like but we all whatever, we all make mistakes. We all would be worth more today if we avoided all our mistakes and only did the things that, were the good decisions in hindsight. But I think in totality, he eats his own cooking. He owns a big chunk of this company. He wants to see this company succeed. There's a big addressable market here. We have lots of tailwinds, good unit economics, cheap valuation. It's a big position for me.
Finally
So
repurchasing shares, just to add
finally
one.
repurchasing shares, correct.
Now let's talk about the newest position in your portfolio that I believe you just published in your letter, Radiant Logistics.
Hmm.
I could see some parallels with IWG in a way with what you're excited about, the asset light piece. But maybe talk about Radiant in its industry. Like, why are they able to compete against some of the larger scale guys? And, talk about what they do first, I guess.
Yeah, so it's a small, non-asset based. I initially used to call it capital light, but management corrected me and they said non-asset based third-party logistics company. So 3PL. They basically help their customers move goods around the world. And if you need to ship a box of t-shirts from Vietnam to your warehouse in Long Island, like you could use UPS for that. But if you need to take like multiple containers worth of goods across the world, like you need someone to help you with the customs clearing and you might need to go on a truck and then go on a ship and then go on a train and then go on a truck again and then end up at your warehouse. And so they basically don't own assets, but they help navigate that complex logistics, path for their customers, and they earn a spread on the revenue they collect versus less the cost of shipping the goods. And so very cap light. And I think they compete with the larger guys like C.H. Robinson and Expeditors by it's a very relationship oriented business. And if you're a shipper of goods, if you're really, really big, you might get really good VIP service from the big guys. If you're kind of like smaller or mid-sized, you might be kind of forgotten about at those big companies. And so this is a very relationship oriented business. The buy rates are pretty similar between the large guys. You know, Radiant's small, but they're not so small. They still generate $1 billion of revenue almost. And so like they're still able to buy, you know, train, ship, plane, truck at scale, and so they get good buy rates. And it's an owner operator, right? Bond, the founder and CEO, he founded this business, built it up through acquisitions. He owns 22% of the company today. The acquisitions they've made have been at very attractive multiples. They typically buy stuff at like 5 times EBITDA. And they have a net cash balance sheet. So they're able to play offense right now in a freight cycle that has been very weak for the last few years, right? 22, 23, 24, 25 have all been pretty bad years. We're starting in mid 22. Um, and, uh, and you know, if you have a good balance sheet and you're able to make good acquisitions in an environment like this, you can create a lot of long-term value. The company trades at a very low multiple because it's a bad economic environment to be in this business and because it's subscale. So I think normalized EBITDA is probably around $50 million. They did like 90 million or 100 million in EBITDA in 2021 or 22. And you know, they probably did 40 million trailing 12 months. But management thinks in a normalized freight environment, they should do around 50 million of EBITDA. Um, Zero net debt today. They're comfortable going up to 2.5 times net leverage. Um, they're generating cash. They could deploy their entire market cap in acquisitions over the next 4 or 5 years. Okay, their entire market cap in acquisition, like into M&A at 5 times EBITDA, if they find the right acquisitions. And even if they don't deploy that amount, you know, they will deploy a lot. And so EBITDA should go from 50 to 75 or 80 or 65 or like it's going to be a higher number, and it's going to eventually trade at a multiple that resembles a much closer level to the scaled public guys, which trade at 15 or 16 times EBITDA. The non-asset based 3PL companies that are public, that are scaled, trade at big multiples. And by the way, if Radiant wanted to sell to private equity today, even though they're not scaled, they could probably sell it for 12 or 13 or 14 times EBITDA today. So trades for 7 times trailing EBITDA, 5 times normalized EBITDA. That multiple should double or triple over time, and they should grow EBITDA substantially through acquisitions without levering up the balance sheet, owner, operator, CEO. I just think it checks a lot of boxes. You know, they could play offense right now, which is amazing. And I do think eventually he will sell the company, you know, and even if not, it'll be bigger, and the bigger it gets, the more public market investors will look at it and be like, man, this is cheap relative to those. I would rather own this than that. So, you know, right now nobody cares, but eventually people will.
Isn't that cheapness relative to those a big challenge when pursuing acquisitions? Like the roll-up economics for an Expeditors at 15x is way better to buy something at 5x than for Radiant.
If you're issuing equity, then your debt to then your multiple relative to your what you're acquiring matters. If you're acquiring with cash, it doesn't matter as long as if you're deploying cash at an attractive ROIC without issuing shares, it doesn't matter where your multiple is today. What
But
matters
it
is your
kind of
trade.
matters, right? If Expeditors could pay 7x instead of 5, right?
Yeah,
Because the accretion is that much. And if
right. But Expeditors, to move the needle for Expeditors, they need to make much larger acquisitions, which come with the larger asset you're acquiring, the higher the multiple, right? When you're acquiring $1 million of EBITDA, you could pay $5 million. If you're acquiring 50 million of EBITDA, you're paying 12 times, okay, or 13 times. So like we're buying stuff at lower multiples, and that smaller stuff moves the needle more for us than it would for them, right? If they were buying stuff for 5 million, the amount of stuff they could buy wouldn't move their EBITDA that much because they're already so big. For us, we're able to buy stuff at those low multiples, and it actually matters for us because if we buy 5 million of EBITDA, that adds 10% to our EBITDA. If Expeditors buys 5 million of EBITDA, that doesn't move the needle for them. So like the beauty of buying these consolidators that are semi-scaled that are able to deploy cash at these low multiples is eventually you should get a multiple of a platform. And it doesn't, I don't know when you'll get it, but when you do, a lot of value will have been created by buying as much as you could for five before you eventually sell the whole thing. Either it trades for 12 times or you sell the whole thing for 12 times or 15 times. Limbach is a great example of that, right? Like Limbach was a subscale, small, de-SPACed HVAC company that was trading for 3 to 4 times EBITDA in 2016 and 2017 and 2018 and 2019 and 2020, but they generated cash and they didn't grow that much at the time because they were transitioning the business towards, higher quality business. But everyone always looked at MCore and Comfort Systems and they're like, yeah, but like it's never going to get to those multiples. Well, lo and behold, it's at those multiples right now, right? They've made a lot of acquisitions, they've grown EBITDA a lot, and the reason why, which by the way, I own Limbach as well. It's not a massive position for me, but it was at one point. Um, the reason it's worked out so well, our basis in it is 10 and change, and the stock's at 90, and it was at 150 a few months ago. The reason that's over a few years is the reason it went up 10x in a year and a half is because the market finally said, whoa, they got to scale. Look at these other guys. Like Limbach can actually make acquisitions that move the needle for it at these low prices. It's a good roll up platform. And like it has organic growth plus inorganic. When you get really big, there's no inorganic growth anymore because to move the needle with M&A, you have to buy big stuff. When you buy big stuff, you have to pay big multiples, and that doesn't create a lot of value. Small and mid-sized businesses could really create a lot of value with acquisitions because they could pay low multiples that move the needle for them. So I love these. I love these setups. I really do. I don't think there's like it's tough to put your finger on when this will work in a huge way because one, no one knows when the freight cycle will normalize, and two, no one knows when Bond will sell this thing. Bond doesn't even know if and when he'll sell this thing, right? He really enjoys running it. He's not that old. He has a lot of energy. If someone knocked on his door tomorrow and said, "Here's 15 stocks at 6," someone knocked on his door tomorrow and said, "Here's $15," I think he'd probably take it. But in the meantime, he's just going to create a ton of value over time. And maybe when he wants to retire, he'll put it up for sale or someone will knock on his door. You need to have a really long-term mindset to own this stock. It's hard to pitch to your PM. He's like, when is this going to work? Earnings are going to suck next quarter and he's not selling the company. Like, why are you pitching this to me? And that's where I think having a long time horizon in these situations really helps. Not a 10 or 12 or 18-month time horizon, but like a truly 3 or 5 year time horizon or plus. In the meantime, they're accreting value by generating cash, deploying that cash into accretive acquisitions. Eventually, we'll get paid in a big way. Until then, hopefully, we get paid in a small way, just through cash generation and some acquisitions. Um, and I don't know. It's hard to know when a good investment will turn into a home run. But if you pick them well, I feel like you'd have a lot of conviction that they will eventually be home runs. And this is one of them that I feel pretty good about.
How fragmented is the M&A landscape for them to attack? What motivates the typical seller? What sort of capabilities is Radiant looking to add? Is it scale that they're after, or are they adding like ancillary abilities as a business? Like, how do you think through
Yeah,
those pieces?
so they have about 100 branches across the US and Canada of these agencies that have basically if you want to move your goods, you call one of their branches and say, I need to move my goods from here to there. Can you help me? Okay. So they have 100 branches across the US and in Canada. They own 30 of them. 70 of them are independent agents, but that are exclusive to Radiant, meaning like if you call that independent agent and you want to move your goods, that independent agent will sell the business to will give that business to Radiant and they earn their commission. Um, so they've been buying up their independent agents at about 5 times EBITDA. They don't want to buy all of them. Some of them are small and actually too small to matter. But if you ask them what the potential EBITDA is of the ones they do want to acquire over time, which there's 70 independents still that they want to acquire over time, and as those independents get older, they become natural sellers of their own businesses. There's probably another 25 million of EBITDA to buy. And now our base is 50. So like we probably have 25. Who knows when we'll buy them, but over time we should buy around another 25 of EBITDA in the bag at 5 times EBITDA. So and by the way, like if that happens over a number of years, we'll still be net cash at that point and we'll have 75 million of EBITDA instead of 50 on a normalized basis, right? So we'll be bigger. Then there's other stuff that they buy outside of their network, and those are harder to predict. But like there have been periods where they've been chunky and big, and periods where there's not that much to do. They're very price disciplined, so they're not going to pay 8 times EBITDA for stuff, especially at the multiple they're trading at. Um, but there's stuff to do. They've had periods where they've deployed very little into M&A, and they're currently the pace has been picking up last year and this year, and they feel really good about the pipeline. So, and Bond was asked this on the last call, how much leverage would you take on? He said 2.5 times is very reasonable for this business. So from zero net debt to 2.5 times net debt, I mean, if you're thinking about normalized EBITDA, that's 125 million of net debt. Just that's without cash generation and without EBITDA growth and without the EBITDA of the acquired business that you're acquiring, right? So like you could deploy a very big chunk of your market cap today. And then over time, the cash generation and re-leveraging that cash generation, like you put a lot of money to work. Will there be that much M&A to do? I don't know, but we're adding a lot of value each year with every deal that we do. So, and we're generating cash.
And you'd mentioned, this idea that we're in a freight recession right now. Earnings are down considerably since 2021. Like,
Hmm.
you also mentioned that it's a spread business. So, how much of the decline in earnings is because there's just less volume running through their system versus do spreads actually get compressed in a downturn? And like, what do you
They
see
do.
happening if this downturn ends up being longer than many would hope? What might happen?
This is a spread business, and spreads blew out, obviously, in a very tight shipping environment coming out of COVID. And that's why they made excess profits. And that's why, the 90 million of EBITDA or so they generated is not what they consider normalized. It's because they recognize that it's a spread business. And the 50 is what they view to be a normalized spread environment. Currently, it's at 40. Can it go lower? Sure. Do we have the balance sheet to withstand it? Yeah. And like the nice thing about investing in companies with a net cash balance sheet or a clean balance sheet is like if things get worse, we will put a lot of money to work at very good multiples and we will come out of it stronger, bigger, more profitable, and more valuable at the end. That's why it's important to have a line management team, good balance sheet. Because like, yeah, the stock price goes down and you suffer a little bit, but you spring right back out of it better than you ever were. It's very nice to be in a drawdown knowing that you're going to be better off than you were before when you come out of it. So um, I don't know. Like, if things get worse from here, fine. We'll buy more stuff, hopefully.
Is there any risk that with tariffs and a permanent trade in the landscape of global trade that you reshore more manufacturing in the US and far less trade ends up going across borders? Everything becomes domestic. Not everything, but at the extreme, maybe everything. Does the business change materially? Is there a big portion of their spread that might become at risk? How do you think about tariffs, trade, and that backdrop?
So I generally think the quantity of goods traveling around the world will go up. I think reshoring and adding redundant capacity means less efficient supply chains and routes and traveling, not more efficient, right? Um, and so I do think long term, it's okay. Um, Over the short term, tariffs, trade war does have the effect of dampening, right? People wait and see, and there's uncertainty, and they pull back, and so that's part of what's hurting us now. The nice thing is, it's non-asset based. We don't own the trucks, right? We don't have this utilization problem, overutilization, underutilization. Like we don't benefit as much in a tight environment because we don't have the right utilization when it goes to 99%. People make a lot of excess profits. But we also don't have this like, oh my God, our assets are underutilized. We still have to spend CapEx to maintain them and we're burning cash in the meantime. This company will always be cash generative because, well, never say always. Like if global trade does slow to a standstill for multiple quarters, like a COVID 2.0 without like global lockdowns, without stimulus, like, yeah, it could burn some cash, but it has the balance sheet to withstand that. Hopefully we get some PPP money, if that happens again. But um, I don't think it's not a medium term or long term risk that I'm really concerned about. We have a good balance sheet. I think long term there will be more goods consumed and transported around the world. Yeah.
Got it. I think that's a great note to wrap up on. I think this has been a fascinating conversation. Really enjoyed hearing about your history. I learned some new pieces, even though I've known you for a long time now. and two very interesting ideas. So if anyone wants to reach out to you, maybe share the best way to find you, and then we could wrap on that note.
I'm on Twitter, One Main Capital, or you could email me around at onemaincapital.com. Please don't tell me how stupid my thesis is.
Or do, because you might learn from it, but no,
Correct.
probably
No, I'm
not.
just kidding. I'm kidding. You can tell me how stupid my thesis is, but don't tell me how stupid I sound.
You definitely don't. All right.